Do you know which IRA is best suited for your financial goals? We're delving into the world of individual retirement accounts today, or as they're more commonly known, IRAs. These financial tools are crucial for planning your future, offering you a way to save, invest, and grow your money over time. But not all IRAs are created equal. Today, we're focusing on two prominent types, Roth and Traditional IRAs. Each has its unique features, benefits, and considerations that can significantly affect your retirement savings and tax situation. Our aim is to simplify these complex financial concepts, making them easier for you to understand. So whether you're a seasoned investor or just starting out on your financial journey, this video is for you. We're going to help you make an informed decision about which IRA is the best fit for your financial goals. Stay tuned as we dive deeper into understanding Roth and Traditional IRAs. First, let's get to know the Roth IRA. The Roth IRA, or Individual Retirement Account, isn't just a savings account. It's more like a financial tool designed to help you save for retirement in a tax-efficient way. Here's how it works. When you contribute to a Roth IRA, you're putting in money that you've already paid taxes on. That's what we mean when we say contributions are made with after-tax dollars. So imagine you've just received your paycheck. The government has already taken its share, and whatever is left, you can choose to put some of it into a Roth IRA. Now you may be wondering, why would I do that? Why would I put my hard-earned money into a Roth IRA? Well, the answer is simple and quite exciting. Growth and withdrawals in Roth IRAs are tax-free. Yes, you heard that right, tax-free. Your money gets to grow over time, and when you're ready to retire, you can start withdrawing it without owing a penny to Uncle Sam. Think of it as planting a seed. You water it, care for it, and over time, it grows into a beautiful tree. The tree in this case is your money growing in the Roth IRA. And the best part? When it's time to enjoy the fruits of your labor, you get to keep them all to yourself. No sharing with the taxman. Another unique feature of the Roth IRA is there's no mandatory distribution age. Unlike other retirement accounts, which require you to start taking money out at a certain age, with a Roth IRA, your money can continue to grow tax-free for as long as you like. But remember, every silver lining has a cloud. The Roth IRA is not without its restrictions and rules, which we'll delve into in the next scenes. Now that you have a basic understanding of Roth IRAs, let's explore its tax advantages. So what makes Roth IRAs a tax-efficient retirement savings option? Well, the answer lies in two simple words: tax-free. Yes, you heard it right. With a Roth IRA, your money grows tax-free and you make withdrawals tax-free. Let's delve into these benefits a bit more. Imagine planting a seed in a garden. With time, the seed grows into a magnificent tree, bearing fruits year after year. Now think of your Roth IRA as this garden. The seed you plant is your after-tax contribution. Over time, this seed grows thanks to the power of compound interest. The tree it forms represents your investment growth, and the fruits, they symbolize the withdrawals you'll make during retirement. Now, here's the exciting part. With a Roth IRA, you're not required to share any of your tree's growth or the fruits it bears with the taxman. In other words, the money you withdraw during retirement is all yours to keep. No taxes, no surprises. This is what we call tax-free growth. Your contributions, after being taxed, grow over time, and the growth isn't subject to taxation. This is a significant advantage, especially if you anticipate that your tax rate will be higher during retirement than it is today. But that's not all. Roth IRAs offer another tax advantage: tax-free withdrawals. Unlike other retirement savings accounts which tax you upon withdrawal, Roth IRAs allow you to make withdrawals tax-free, provided certain conditions are met. This means that every dollar you pull out during retirement is yours to spend, without having to factor in taxes. Sounds like a dream, doesn't it? But remember, there's no such thing as a free lunch. The tax benefits of a Roth IRA come at a cost. You pay taxes upfront on your contributions, but for many, this is a price worth paying for the promise of tax-free growth and withdrawals in the future. Roth IRAs certainly have their tax perks, but are you eligible to contribute? Let's delve into that in our next section. Not everyone can contribute to a Roth IRA. Let's discuss the eligibility requirements. First, the Roth IRA has income limitations. If you're single or head of household, the amount you can contribute begins to phase out if your adjusted gross income is more than $124,000. It phases out completely if your income is over $140,000. For those who are married and filing jointly, these phase-outs begin at a combined income of $196,000. and it phases out entirely at $208,000. Now let's talk about the contribution limits. If you are under the age of 50, you can contribute up to $6,000 per year to your Roth IRA. However, if you're 50 or older, you get what is called a catch-up contribution, allowing you to put in an additional $1,000 for a total of $7,000 per year. Another point to remember is that you can contribute to a Roth IRA at any age, as long as you have earned income. This is a significant difference from a traditional IRA, which does not allow contributions after you reach the age of 70 and a half. It's also essential to note that you can contribute to a Roth IRA even if you're also contributing to a 401(k) or another workplace retirement plan. This is a fantastic way to maximize your savings and take advantage of the unique tax benefits that a Roth IRA offers. Finally, if you're unable to contribute to a Roth IRA due to income restrictions, there is still a way. You can contribute to a traditional IRA and then convert that into a Roth IRA, a process known as a backdoor Roth IRA. But remember, this maneuver comes with its own set of tax implications, so it's crucial to discuss this with a financial advisor. Understanding the rules is essential. Now, let's move on to the withdrawal rules of a Roth IRA. When can you withdraw your savings from a Roth IRA without penalties? This is a critical question that we're going to tackle in this segment. Generally, the golden rule of thumb for Roth IRA withdrawal is 5 and 59 and a half. You might be wondering what this means. Well, it's quite straightforward. The 5 refers to the 5-year rule, which means that you must have had your Roth IRA account for at least 5 years before you can withdraw your earnings tax-free. Keep in mind we're talking about earnings here, not contributions, which can be withdrawn anytime without taxes or penalties. The 59 and a half part refers to your age. You need to be at least 59 and a half years old to make a tax-free and penalty-free withdrawal of earnings. So, the two conditions for a qualified distribution are pretty clear. Your Roth IRA must be at least 5 years old, and you should be at least 59 and a half years old. But life is complex, and there are always exceptions. For instance, the IRS does allow for early withdrawals under certain circumstances, such as a first-time home purchase, certain educational expenses, or in the case of disability, or certain medical expenses. These are known as exceptions and can be quite helpful in times of financial need. However, remember that these exceptions come with their own set of rules and restrictions. Therefore, it's crucial to do your homework before making any hasty decisions. After all, the primary purpose of an IRA is to save for retirement, and early withdrawals could potentially jeopardize your future financial security. So to sum up, the key to making penalty-free withdrawals from a Roth IRA lies in understanding the rules, being patient, and planning accordingly. It's not just about saving, it's also about smart and strategic withdrawing. Now that we have a solid understanding of Roth IRAs, let's shift our focus to traditional IRAs. Now let's explore the other side of the coin, traditional IRAs. We've talked about Roth IRAs, and now it's time to dive into traditional IRAs, another tool in your retirement savings toolbox. At its core, a traditional IRA, or individual retirement account, is a type of savings account designed to help you stash away money for your retirement and enjoy certain tax advantages. One of the main features of this type of account is that the contributions you make are often tax-deductible. What does this mean? Well, let's say you contribute $2,000 to your traditional IRA in a year. You could potentially deduct that amount from your taxable income when it's time to file your taxes. So if you're in the 25% tax bracket, you could save $500 on your tax bill. Sweet, right? But of course, there's a catch. While you're saving on taxes now, you'll have to pay them later when you start taking money out of your account during retirement. Unlike a Roth IRA where qualified withdrawals are tax-free, withdrawals from a traditional IRA are taxed as ordinary income. It's also worth noting that, just like a Roth IRA, your money grows tax-deferred in a traditional IRA. This means that any interest, dividends, or capital gains your investments earn won't be taxed until you start making withdrawals. Now, you might be wondering, why would I choose a traditional IRA over a Roth IRA? Well, it all depends on your specific financial situation and goals. If you expect to be in a lower tax bracket when you retire than you are now, a traditional IRA could be a good fit for you. Remember, the beauty of these IRAs lies in their flexibility. You can choose the one that best fits your needs, or you can even contribute to both types if you want to hedge your bets. With the basics down, let's delve into the tax advantages of a traditional IRA. How does a traditional IRA help you save on taxes? Let's dive into that fascinating question. A traditional individual retirement account, or IRA, is a tax-deferred retirement plan available to anyone with an income. It's like a special savings account, but with some tantalizing tax perks. The main advantage of a traditional IRA? Tax-deductible contributions. Here's how it works. When you put money into a traditional IRA, you can deduct those contributions from your taxable income when tax season rolls around. In other words, if you earn $75,000 in a year and contribute $5,000 to your traditional IRA, your taxable income drops to $70,000. So, you're essentially lowering your current tax bill by saving for your future. It's a win-win situation. Now keep in mind that these tax deductions are subject to income limits and participation in employer-sponsored retirement plans. If you or your spouse have a retirement plan at work, your deduction may be reduced or eliminated. But don't worry, even if you can't deduct your contributions, you can still benefit from tax-deferred growth within the account. What does tax-deferred mean? It's another great perk of traditional IRAs. The money in your account grows without being taxed until you start taking withdrawals in retirement. So your earnings compound over time, free from the grasp of Uncle Sam. But remember, while these tax advantages are appealing, they come with a catch. When you start withdrawing money in retirement, those withdrawals are taxed as ordinary income. That's the deferred part of tax deferred. You're not avoiding taxes entirely, just delaying them until a later date. So, to recap, the tax advantages of a traditional IRA include tax-deductible contributions and tax-deferred growth. These benefits can make a significant difference in your retirement savings, helping you build a substantial nest egg for your golden years. Traditional IRAs can indeed be tax efficient, but who is eligible to contribute? We'll get into that in our next segment. Stay tuned. Who can contribute to a traditional IRA? Let's discuss the eligibility requirements. Now, you've heard about the differences between individual retirement accounts and are interested in getting started. But there's a question you must answer first. Are you eligible? Unlike Roth IRAs, there's no income limit to contribute to a traditional IRA. However, there are age restrictions. You can contribute to a traditional IRA until you reach the age of 70 and a half. After that, contributions must cease. Let's dive into contribution limits. The IRS sets these limits annually. For 2023, if you're under 50, you can contribute up to $6,000. If you're 50 or older, you can make an additional catch-up contribution of $1,000, bringing your total allowable contribution to $7,000. Remember, these limits apply across all your IRA accounts. So if you have multiple IRAs, the total contribution must not exceed these limits. But here's where it gets interesting. While anyone with earned income can contribute to a traditional IRA, the ability to deduct those contributions on your taxes is income dependent. If neither you nor your spouse has a retirement plan at work, you can deduct the full amount of your contribution. However, if you or your spouse does have a retirement plan at work, the deductibility of your contributions will phase out at certain income levels. So, let's say you're single and you have a retirement plan at work. In 2023, if your modified adjusted gross income is $65,000 or less, you can deduct the full amount of your contribution. But if your income is between $65,000 and $75,000, your deduction will gradually phase out. And if your income is above $75,000, you won't be able to deduct your contributions at all. Just like with Roth IRAs, understanding the rules is key. Now let's discuss the withdrawal rules of a traditional IRA. When can you withdraw your savings from a traditional IRA without penalties? A question that often pops up when discussing individual retirement accounts. Let's start with the magic number, 59 and a half. That's the age at which you can start making withdrawals from your traditional IRA without incurring a 10% early withdrawal penalty. However, remember that these distributions will be subject to income tax as they were tax deferred when you made the contribution. But what if you need those funds before reaching the age of 59 and a half? Well, the IRS does allow exceptions to the early withdrawal penalty under certain specified conditions. For instance, you may be able to withdraw funds without penalty if you become permanently disabled, or if the funds are used for qualified higher education expenses or first-time home purchase, up to a $10,000 limit. It's also worth noting that starting at age 72, you're required to take minimum distributions from your traditional IRA, known as Required Minimum Distributions or RMDs. If you fail to do so, you could face a hefty 50% tax on the amount that should have been withdrawn. Withdrawing from your IRA is not just about age, but also about understanding the conditions and consequences. Remember, the goal is to maximize your retirement savings and minimize your tax burden. With a thorough understanding of both Roth and traditional IRAs, let's see which one might suit you better. Roth or traditional IRA, which one is right for you? That's the million-dollar question, isn't it? When it comes to choosing between a Roth and a traditional IRA, several considerations come into play. Firstly, your current tax bracket. If you're in a high tax bracket now but anticipate being in a lower one during retirement, a traditional IRA might be more appealing. Why? Because your contributions are made pre-tax, giving you a tax break now when it might be more beneficial. Secondly, your expected future tax bracket. If you believe you'll be in a higher tax bracket when you retire, a Roth IRA could be the better choice. You pay taxes now, at your presumably lower rate, and then enjoy tax-free withdrawals in retirement. Finally, your retirement plans. If you're someone who likes to keep your options open and may need access to your funds before retirement age, a Roth IRA offers more flexibility, allowing for penalty-free withdrawals of your contributions at any time. On the other hand, if you're confident you won't need the money until you're in your golden years, a traditional IRA might suit you. It encourages long-term saving with early withdrawal penalties. Remember, the choice between a Roth and a traditional IRA is a personal one, based on your individual financial situation and goals. So consider these factors, consult with a financial advisor if you need to, and choose the route that best aligns with your financial future. Stay cash money minded.